The Federal Reserve just dropped a huge bomb. They confirmed the money printing pivot is happening. Get ready for serious changes because this is going to fuel inflation. First, the Fed cut interest rates. They decided to lower the rate by a quarter point. The main Fed fund rate is now sitting at 4%. That was expected. No surprise there. But here's the shocker that matters. The money tightening cycle is officially over. Finished. The Fed decided to end the reduction of its securities. This means they are done trying to shrink their massive balance sheet. This is the end of what people call quantitative tightening. This change kicks in on December 1st. What does this mean for you? It means they just took the first big step toward printing money again. I've been telling you for a year how this works. First, they cut rates. Second, they stop tightening the money supply. Third, they fire up the money printers, likely around 2026. When that happens, inflation is going to come roaring back with a vengeance. Right now, the Fed says they are entering a new phase starting in December. They plan to hold the size of their balance sheet steady for a time. But let's be real. They're just waiting for something in the financial system to break. When the system cracks, they will ride into the rescue with massive money printing. Over the last 3.5 years, the Fed reduced its holdings by about $2.2 trillion, but they are ready to turn the machines back on. Now, let's talk about the next meeting on December 10th. Before the recent meeting, the market thought there was a 93% chance the Fed would cut rates again in December. But Fed Chair Jerome Powell said a December rate cut is not a sure thing. He said they have not made a decision yet, and there are strongly differing views among the people who vote on this stuff. Why the sudden confusion? The Fed is playing games with the numbers. Some committee members believe the Fed fund rate is already where it needs to be, noting they have already cut rates by 1.5 percentage points. Many estimates say the neutral rate, where rates should be, is generally between 3 and 4%, and we're right there now. Another massive problem is data. The Fed claims they make decisions based on what they see in the job market and inflation numbers, but because of the government shutdown, they do not have the solid labor market data they need. Powell says the lack of information could affect the decision in December. He compared the situation to driving in fog. If you can't see ahead, you slow down. The Fed might become more cautious about making a move because they are flying blind without that government data. They hope the data will flow again by December, but if it doesn't, they might argue they need to pump the brakes. Despite all this, the Fed insists it is absolutely committed to getting inflation down to 2%. They say this is a credible promise and you should believe them. They also addressed current prices. The Fed admits people are seriously unhappy about inflation, and they should be. That pain comes from the huge price increases we saw back in 2021, 2022, and 2023. Even if prices aren't rising as fast now, everything is still much higher than it used to be. The Fed expects this unhappy feeling to last for quite some time. People will only feel better once their real incomes finally catch up to those inflated prices. So the tightening is over. The money pivot is confirmed. Keep your eyes locked on December 10th. If you want to stay ahead of the game, make sure you hit the like button, subscribe to the channel, and ring the bell notification. I'll see you next time.